Yeah, welcome everybody to our webinar today, from descriptive to prescriptive, transforming analytics in revenue growth management. With me together, we have Ingo and Tim. I think you're both in Cologne, or Tim, you're in Düsseldorf, right?
Yeah. I'm currently in Düsseldorf.
You're up the Rhine River. Yeah, as always, where is our audience coming from? So we are three from Germany right now. Please type in the chat where you're tuning in from today. Usually we see a worldwide audience. Exactly, yeah. South Africa, Munich, nice. London, Bulgaria. It's so nice to see everyone tuning in from all over the world. Nice. USA, Germany, Hamburg, Mexico City. Okay. On the next slide, I think quickly introducing our two experts for this webinar. Obviously, you know Ingo Reinhardt, co-founder and managing director of Buynomics. He has so much experience in pricing and revenue growth management. We are doing these Buynomics webinars for close to 4 years, I think. And we still have exciting topics to bring to the table. And with him together, we have Tim Schneider, our head of customer value, really the expert in the tool. And you will see in the demo we show after the theory section, we bring with us a new exciting tool feature today, the feature release of the Buynomics Decision Guide, which kind of aligns to the topic of today's webinar. But yeah, I would leave the room to you guys now, and I will come back once we do the poll.
Very nice. Thank you, Jonathan. Yeah, jumping maybe a little bit in giving some background here. So Buynomics, overall, what are we doing? We're creating a platform which basically empowers better pricing decision in revenue growth management, and also helping there basically do the decisions better, not only for pricing, but also for PPA and mix. Why can we do that? Our solution basically has an overall holistic approach on how to basically do all of the changes in one true market simulation. We've discussed it in our last webinar. If you're interested in that holistic approach of our solution, please feel free to check out the recording of the old webinar from 2 weeks ago. We pride ourselves with very high predictive accuracy and an extreme fast or very speedy way to insight, or a quick way to insight, whereas we reduce forecasting time around 70 to 90%. And all of those above really lead to a higher profitability for all of our clients. And now, with no further ado, Ingo, I'd like to hand over to you for the very interesting topic today.
Yeah, thanks, Tim, for the intro, and also thanks, Jonathan, for the first intro, and thanks everyone for joining today for the webinar. I think it's an exciting topic, and that's the case because we're in an exciting phase in the field revenue growth management at the moment, moving broadly from probably in most cases a focus on descriptive analytics to more predictive and prescriptive analytics. So this is going to be the topic of today. And I would say we're not alone in this journey, and pretty much every science, every discipline has gone through it. And just as an example, I looked at a number of cases in medicine, in biology, and in this case here in astronomy. Every discipline that you look at from the proper distance really has gone through the case. And what I have here is essentially an example just to highlight and build some context from astronomy, where you look at and also to explain the basic concepts we're talking about. Descriptive, what does it mean? It's essentially focusing on observing, recording, and cataloging certain phenomena. And in this case here in astronomy, it's about and a lot of work already the ancient Greeks and in the Middle Ages has been done to catalog essentially the nightly sky and understand where certain planets are at what time, where certain stars are in this case here, just to get an understanding and map out what is out there. And the focus initially was really on just mapping out what is there. And here's an early drawing, I think from the early 17th century. And it's here the Ursa Minor, little bear, the star sign, just as an example. So this is the descriptive part, just saying, okay, that's where the stars are. This is what the nightly sky looks like. And essentially then the next step, much later, maybe starting with Kepler, Newton, we all know the famous names, and Einstein, explaining why the planets, but also why the stars behave in a certain manner. So this goes from just describing to understanding what moves a system, and then with understanding how the dynamics of a system work, being able to predict what will happen next. So we can predict where planets will be tomorrow, in a week, or in 100 years, and also sort of make use of that knowledge. So when you want to travel from here to Mars, there are times in the year or over the years where it's much easier to reach Mars, because you know how far Mars will be away from us now or in a couple of months. And you can use that knowledge to find the best moment to get started to travel to Mars, for example, or do many other things, right? And this is really the evolution that we're also going through in our discipline, maybe coming from more from a descriptive view on analytics. How do just describing, we ran a promotion and it gave us an uplift of maybe 3 in terms of sales, to understanding why did we get this uplift of 3, and what happens maybe if we run a different type of promotion. Would it give us 3.5, or will it only result in 2.7, for example? So this is really the question we're dealing with. And maybe, Jonathan, before we go more into the details, maybe now is a good time to put our second survey after the countries.
Yes, we have a survey, a poll that we are launching now. Let me know when you're seeing it. Which type of analytics are you currently using in your organization? Descriptive, what happened? Predictive, what will happen? Prescriptive, what should I do? Other, or you're not answering? And yeah, I give you some
put
time.
Other, please. It would help us, or help everyone, if you can just write it in the chat, so we can understand what it is.
Definitely. Yeah, we are at 52 participation rate right now. Let's get to 60% the poll and share the results with you. 62%. Okay, wow, that was fast. Some seconds, so please make a decision now. I will close the poll in 1, 2, 3, and poll, and now share the results. So you should be seeing the results, Tim and Ingo.
Tim, what do you think?
Yeah. Very, very interesting. Actually, almost still what I would have expected. A lot of descriptive, some predictive, very little prescriptive, actually. Understandably so, because it's very, very hard to do in a clear manner. What's your thoughts, Ingo?
Yeah, no, it's what I expect from based on what I learned talking with many clients and prospects. This is really, I think, where the focus is in most cases here.
Nice.
Good. Okay, so let's dive into our field, RGM. So just to get started, and just that we have start with a common understanding of what we're talking about when we talk about RGM. Essentially, we're talking about these 5 levers here. So essentially holistically steering our portfolio by looking at what happens when we change prices, or retailers change prices in the end. How does it affect sales? What happens when the price pack architectures change, when we change, for example, the size of a product, or add a product, remove a product? What happens when promotions are changed? We run different types of promotions. We run different depth of promotions, 20, 30, 40% discounts maybe. We change the type of products, or the selection of products we promote together. We steer differently across different channels, and we also look at our trade spend. I think today will be more the focus on the first 3: pricing, PPA and promotions. But essentially, when we talk about revenue growth management, we're talking about steering these different levers, ideally holistically. So looking at what happens when we steer 2, 3, 4 of these levers together, and also using all of these levers to come to a good solution in the end. So what does it mean when we start with descriptive analysis? I think the most common, or what I see most of the time in the field, is something like this, and this is super simplified, but it captures the essence. So you're looking at your past sales. You know your sales here for 10 weeks. You have the units, and you have the price. So the pricing might differ in each week a little bit, and you can use that knowledge to understand if there's a price sales relationship, and you can also use it to understand what the effect of the promotions is. And just descriptively, you can a typical finding would be that if you look at it, the average promotion uplift is around 800 units in this case. And by looking, let's say in this case, only at the non-promoted weeks, you will find that the price elasticity, if you just run a linear regression through it, is around minus 2.7 at a price of 219. It's different at other price points, but in this case at 219, it's around 2.7. So this is a descriptive analysis. You see that this simple analysis gives an okay assessment, but already you see that the promotions in week 7 and week 10 have different effects. So you see that they do have an effect. On average, it's 800, but what you see is not very precise, right? It's very different in the 2 weeks. And it might be that something else is going on. Maybe a competitor is also promoting a product in week 10, but not in 7. So there are maybe other things going on. So this is a simple descriptive analysis that most of us do, and a very simplistic, and in this case, not very good way to use the results. When we move towards prediction would be to just apply this moving forward and say, okay, expect an uplift of 800 every time we run a promotion. That's, I would say it's doable, but we already see that we can't expect too much precision from this, right? But this is the type of analysis, descriptive analysis that most of companies do, and based on the graph that we've seen before, that also many of us here in the audience are performing. Another example is probably something like a conjoint analysis, where you ask people something, or you show participants something like the table here at the top, show them different TV screens, different TV products, different brands, different technologies, different sizes, different prices. They answer what they would buy, and based on this, you can get, again, descriptive results of the nature where you say, okay, this is the importance of the different drivers. So in this case, in this study that was run based for these products, see that pricing was most important, and all the different features also had different impacts. And you can typically, with this type of solution, also see, for example, how valuable the different brands are. So where you have brand A having relative to their negative value, and C being the most valuable brand. So this is the type of descriptive analysis, and you can use it, for example, when you are one of these brands here, you can use it to infer, again, as in the previous example with the time series on prices and sales, where you say, okay, we can expect on average a promotion uplift of 800. You can say, okay, this brand C is, what is this, a certain 10% roughly better than brand B in this case, right? So you can infer this, but inferring from this that it's also right to price your product 10% higher than if you C compared to B, that's a stretch, right? It's not clear why you should be able to infer that you can price 10% above brand B from these results. So as we said, you're just describing, and it's in the sense that you're just providing descriptive analytics. You're not really doing anything wrong, but it's Where it becomes more difficult is then actually making inferences from that and using it for as a basis for an actual action, for example, pricing your products in this case. So as we move from descriptive to prescriptive, what do we actually mean? So, and when we say prescriptive, we typically mean three things. If you disagree, just write it in the chat. Happy to discuss this at the end of the webinar. We mean three things. We mean when we want to be able to prescribe something with analytics or with a tool or system, we need to be able to predict. If you remember back the astronomy example that we had, we need to be, if we want to travel to Mars and find the right time to travel the shortest distance to Mars, we need to be able to predict how Earth and Mars will move in the coming months, years, forever, how long ever the travel takes, to find the right spot when or the right moment to start our journey. In the same sense, if we want to properly use different promotions or want to use them in the right way, we need to be able to predict what happens when we run a certain promotion. And ideally for us in revenue growth management, I think two things are really key because of the complexity of our challenge. We need to be able to understand what happens when we run or use all the different levers at the same time. So what happens when prices, promotions, and PPA are changed? And the other important factor is we need to be able to understand how a change in one product also affects the other products. So for example, if we change the price of one product, how does it affect our other products in our portfolio, but also how does it affect our competitors? Likewise, if a competitor does something, how does it affect our products? So we need to be able to understand what happens when we look at the different levers together, and we need to be able to understand how different product changes affect the rest of the products typically in the category. Then we need to be able to properly make recommendations based on that. For example, have a system that allows you to find an optimum. What's, for example, the profit optimal price, or what's the profit optimal pack size for a product. And because whenever we interact with analytics, or we interact with the tool, with the system, we like to be able to get an explanation why something happens. Tim also probably more than I do, hears this quite a lot. So people don't like, and for very good reasons, don't like black boxes where things just happen and they don't understand why. So that's why we need to be able, or system needs to be able to explain why certain things happen. So for example, we increase the price more, in this case, because the price elasticity is lower, or we increase more because the cost changed more in this product. So we need to be able to understand the dynamics of the system, to trust the system and work with the results. This is one thing. I think expandability is important, and also has to do with the prediction, of course, the precision of the prediction the system performs. Again, if you disagree, please let us know. We're happy to discuss at the end of the webinar. So what does this look like in a very simplistic case? And I think this is the simplest case we have in revenue management. Let's imagine the textbook case where there's just a single product, and we're living in a world with a single product, and we pretty much know everything about this product. Particularly, we know, of course, the internal stuff. We know the cost of the product, but we also know the price elasticity of that product. In reality, of course, it's very difficult to get very precise elasticity measures, for example, using a regression analysis. But in this case, we know that the price elasticity of the product is -2. And with simple analytics, we can also identify that in the profit optimum, we always have margin times price elasticity is -1. So for example, as in this case, if we have a price elasticity of -2, the profit optimal margin is 50%, right? So if our costs are 100 euros, then the profit optimal price is 200 euros, okay? So in this case, if we go back to our criteria, we are able, so when we change the price, we're able to predict what happens. if we increase the price 10%, we know how many units we lose. We're able, based on this criterion, margin times price elasticity is -1, we're able to recommend and identify the optimum, and we can explain it because we've completely and in full transparency laid out the dynamics of the system and the criteria for why a certain price is the optimum. So in this simple example, these 3 criteria are fairly easy. And for example, if price of our costs increase from 100 to 110, that would mean that the profit optimal price goes to 220, right? So that we always stay at the margin of 50%. Likewise, if the costs go down, it makes sense just from the analytics of the situation to decrease the price if the -2 price elasticity is correct. So in this simple textbook case where there's only one product, no interaction, no competition, nothing, it's super simple to go from descriptive -2 to predictive, applying the formula and understanding what is the best move after a cost increase or decrease. Luckily for us, but more difficult, more challenging in the situation. Luckily, I say, because if that was the end of the game, that was very boring, and we wouldn't have enough content to run webinars every couple of weeks. Luckily, therefore, reality is a bit more complex. There are tons of products. It's difficult to assess price elasticity with really these simple measures. And that's why I think it makes sense to have a more elaborate and more detailed method to understand reality. And this is the next step I want to talk about. And without going too much into detail, this is essentially the technology that we're using, that we're calling virtual shoppers. And the basic idea is that we create very large sets of these virtual shoppers that really replicate the buying behavior of real shoppers, and that make buying decisions that are very similar to what real shoppers would do. And you can use them to analyze what happens when you run all kinds of changes. So for example, you have all of these virtual shopper parameterized based on the available context data. And you show them an offer here, again, simplified with 3 products. And then the color here indicates what they would buy. And if you, for example, increase the price of this first product here, more and more of the people who would buy this first product move to the other products because they become relatively more attractive, just as in the real world. And if you continue increasing the price $2 to $3 to $4, more and more, you will lose more and more sales. This gives you a demand function for this product. And with the demand function, you have revenue, profit, everything you're interested in. And what you can't show on a slide, but what you can show in a tool in a second, is that, of course, that all of these curves interact with each other. So if you increase the price of this product, more will go to the other products. And then therefore, as you increase the price here, the demand curves in the other products shift upwards. All right. And with this, I'll hand over to my colleague Tim for a specific example.
All right, so what you're seeing at the moment is the Buynomics platform, really, where you can do these types of analyses, so predictive as well as prescriptive analysis. And before jumping in really into our newest feature, which we call the decision guide, which really helps you to do prescriptive analysis, set objectives, and understand what you need to do to achieve them, I would like to jump quickly into our main scenario planner to just emphasize again that each of our scenarios is really being modeled on the most granular level. So we're simulating a market really on an SKU level and truly per week. So as you see, this one SKU has a different pricing across the different weeks with different sales, different revenues, and so on, really throughout the entire year. And it's the same for all of the other SKUs in the market, including competitors. So it's a very, very granular model. And in the next step here, really, the decision guide, I will show you how this very granular model is being used to simulate a vast number of solutions to then show you or help you to get your objectives right. Let's do that right away. So we jump into our really latest feature decision. I think everybody at Buynomics is extremely proud of this new feature. And we just open the discovery. Great. So what you see on the screen is not really the decision guide. Let me quickly reduce the filters here that I did before. So just that we see one time truly everything. Here we go. And what does this decision guide do? What you see here in the chart is truly the revenue, manufacturer revenue, as well as the manufacturer profit, and a lot of different dots. Each of these dots is representing one scenario. And as you saw before, what I showed is really this very granular scenario. And what does the decision guide do? The decision guide basically helps you model a vast number, as you see here. In this case, it's 1,218 solutions, 18 scenarios with different price changes based on the objectives you try to optimize. So here in this case, we have chosen the objective profit manufacturer and revenue manufacturer. And based on the decision guide, it gives us a lot of options on how we can get better in each of these points. And we see that here on the blue line, there's some sort of efficient frontier developing where you basically cannot get better in one KPI without sacrificing one of the others. And we have here, when we focus on this one on the bottom here, this is really our starting solution. And based on that, can go anywhere. The nice thing about it is you can actually start narrowing it down. So of course, we might want to not consider any scenario that is negative in terms of profit for the manufacturer, neither for the revenue. So that's what was in here before. So you can really define with these little sliders here. Let's just take 0 and 0. So we just want to look at cases where the manufacturer revenue and profit is actually positive. So it's a really good case. And that narrows everything down here on the top. So you see here the different scenarios, and on the right side, you see really partly the different changes per scenario for acceptable ones, for best-in-class ones, and so on. All right. So that's basically that. And of course, we have like the option to do a very detailed comparison on that one, but I will not go too much into detail on that. I will just quickly show it. So ultimately, the tool will, instead of letting you model all of that in your own time, will actually give you the opportunity to say, okay, you know what? I would like to optimize my revenue, and maybe I want to consider my profit as well. And you can let the solution do the heavy lifting. It will give you the options that you have on the table, and then eventually out of these options you can actually choose the ones that seem to fit best to you, but then also detail them out. So on the bottom here you find already a detailed comparison. You can now look at different KPIs here. Again, I won't go into too much detail, but once you have found these solutions and you thought about, okay, maybe this one or that one here, for example, is like a nice case, then what you can do is, when you click on this one here, for example, you can save it as a scenario and do further analysis. As you see here, this little one I have already saved, and we can now really jump into the concrete analysis part. So when I click on this one here, I will jump over, and I had prepared here like a nice view of this one already. So what you see, this is truly the result of our decision guide. And as you see, again, it's really granular. It's the same granularity level as the base that I showed you before. And you have different changes for the different products. So you see some products, they decrease in price, some products, they're being increased in price, all depending mainly on the resulting elasticities here. And you find results in terms of units. When we move a little bit further to the right, you see then also here this win-win case for revenue and profit for the manufacturer, really. So there's like roughly plus 3% in profit and plus roughly 0.9% in revenue. The nice thing about that one, about this decision guide, when I quickly go back here and we go again into our discovery where it just was. So this little scenario is only one out of these thousands, or like 1,218 concretely that have been created. And what you can then do is basically check another one and also save that and compare these two to find really your optimal set of actions for your objective. And of course, there's certain, let's say, market knowledge that you hold that the solution just might never be able to understand or learn. And for that, we have actually this option in the scenario space that you can do the adaptation. So when I go back to the scenario space again, and as you see, it's really easy to move in between those two to toggle. When I'm here again in this one scenario, you can, based on your knowledge, adapt the changes again and can say, okay, you know what? Actually, these price changes, they don't really, they're not perfect. So certain products, they might, should be changed differently. And then you can do these adaptations here. All right. That would be mainly it from my side. Ingo, anything else that you would like to add to this feature?
No, makes sense. I think we're moving towards the end of the time, but just to, I think it's helpful also here with the elasticities, as you said, that it makes sense to essentially justify why the system recommends or predict certain changes here. In the sense that where we have the lowest elasticities, we tend to have the price increases. Where we have cases with very low elasticities, we have price decreases. In this case, I think there was one question if we also can limit and only have scenarios without price decreases. You can certainly enter that as a constraint here. So these things are all possible here. And again, won't go too much into detail now, but it also allows you to understand and understand why certain predictions are made, why the system sees price increases, certain volume increases or decreases for certain products and interactions. It really makes it transparent and easy to understand. And you can also, if there are constraints that you cannot enter completely, there are always like some exceptions. When you have a large portfolio, there's something special about individual products. You can always make manual adjustments at the end to these outliers. I think that's always also very helpful. Let's go back to the presentation.
Yeah, maybe one last part. I think there was one question around deciding on constraints for the optimizer, and that's of course possible. So the optimizer runs with a lot of constraints, as you see here, KPI constraints. I didn't have any applied. Also have no product constraints applied, and the ranges were from -2 to +8% in changes. You can of course adapt it to 0 to 8 so that there's no negative price changes allowed. Again, like the summary of our decision guide, I think as our latest feature is a really nice one in my opinion. I think, the entire team is quite proud of it because what you can do with it is actually automatically identify differentiated price optimization potential across your products and across relevant target KPIs. So not just revenue or profit from the manufacturer perspective, but also a sellout volume or like retailer profit, for example. Also implementing the relevant guardrails and constraints, super important to have like eventually capacity constraints or a certain price ladder or price ladder constraints where you want to say, okay, certain products are not allowed to be more expensive than others. Those can be added. As well as competitors' reactions, which can be quite powerful. So whenever one of your competitors actually would do a new pricing, for example, decrease prices in a way that you would have not expected, because currently we're in an inflationary environment, then you can directly jump into the tool, create the scenario, and see what the decision guide would help you with in terms of best response. So all of that is very nicely adapted, and you can then fine-tune all of the results, of course, to your needs. Great.
Nice. Let's go to
Q&A part. Thank you so much, Tim. I think was a really exciting tool demo. I think the question from Amelia we already talked about and answered it. We have another question from Patricia. Where does the data for the virtual shoppers come from?
Yeah, so a lot of the parameterization comes from the context-specific data that would come from our customers, and it's really I would say we can use all the typical data that's available for pricing revenue management, and it really depends on the context. What is then used? Typically, it's the sales data that's the foundation of the analysis, but we can work with all the typical data sources that are available to pricing and RGM professionals.
Okay, thank you, Ingo. And then right in the beginning, or at the half part of the first part of the presentation, we had a question from Victor about the linkage of prescriptive analytics to value-based pricing.
Yeah, I would say, I mean, I would say an obvious one. So you can sort of in the first step, if you, let's say, maybe if you're new to an industry, you can just look at what your competitors or the incumbents in an industry, how they price their products, and then based on that derive what's the markup. Let's say take another industry or in automotive, you can read out, so an extra horsepower costs typically around, I don't know, 30 or 50 euros, right? So you can infer from the actual prices. If you're new, you can infer what the different competitors how they value the different attribute levels in the different value drivers. So that's an obvious thing. You can make this a little bit more elaborate with something like regression analysis, where you also include not only the prices but also the sales volumes, where you say, okay, this feature is priced 100 euros higher than another feature, but fewer people buy it. Therefore, on average, it's just valued at 50, right? You can do that. Or, and I think should be the gold standard, is what we do with our virtual shoppers, where you simulate how the virtual shoppers, in this case, value the different attributes. And from that, you get the most precise understanding of how different attributes are valued, not just on average, but the full distribution, right? So not everyone. So when you say, I don't know, let's again take automotive. BMW is 5% more valuable than a Mercedes in a certain segment. That's of course not true for everyone, right? It's maybe on average true, but you have a full distribution, and the distribution you can identify with, for example, the virtual shopper much better than with other techniques.
Yeah, thanks, Ingo. We have two more questions just coming in. I will read them out loud for people joining by phone. Does the model make any adjustments in case of a product or category in expansion, meaning the elasticity would be very low due to other factors beyond price changes, e.g. distribution, new shopper behavior, etc.?
Yeah, there are all kinds of things going on. So there's seasonality and there are also trends, and those are being considered and captured.
Okay, thanks. Very precise. And from Christian, in case one cannot use Buynomics solution right now, what would be your next best thing advice to move towards prescriptive analytics in RGM?
It's hard to say, but I mean, I would say what you see most is alternative. I mean, it always depends on if you buy something or if you have to do it yourself, how tech savvy you are. But I would say maybe not halfway, but you get a third of the way if you're good with Excel and analytics. So as in the first example with the price sales volume per week example that I have, you can identify like an average uplift which gives you an indication, but doesn't give you the full transparency on what happens, right? And particularly if you have meaningful sales, that difference makes a huge impact on your top and bottom line. But if you're, I don't know, selling oranges in your backyard, you can probably do the analytics with Excel.
Okay. And then a last question, also considering the time. Does the virtual shoppers concept apply only to retail industry, or can it also be applied to other industries such as telecom, tech, etc.?
Yeah, so we also work in telecom, tech depends a bit. Tech is a broad area, but in general, it can be used across a wide range of industries. There are some properties that we cannot map at the moment, but if you are from a specific industry, yeah, I think it's easiest to reach out to us. You can reach out to myself or Tim or Jonathan or via our website, and then we're happy to have a discussion. But it can be applied across a broad range of industries. We already work across different industries, but there are some phenomena that we can't capture at the moment.
Okay, thank you so much for answering the questions. If we go to the next slide, I wrap up with the marketing part and what's happening next. So we will tell you what the next webinar will be. It will probably be happening on the July 26th. So in the middle of summer, I hope to see you all again there if you really like the webinar. And we will, as always, we will follow up with an email, sending you the recording, sending you the slides, and sending you a link, not only to the decision guide landing page that I pasted already in the chat, but also the registration link for Zoom for the next webinar. And then I think that's all from my side. Thank you very much, Ingo and Tim, for presenting today. I think we learned a lot about this new feature of decision guide and prescriptive analytics in general. And thank you to everyone that was attending this session. It's always nice to see you joining from all over the world. And I think we had a lot of engagement in terms of questions today. If we're not hearing from each other, we wish you all a very, very good weekend, a nice summer, better weather than we have in Cologne right now. It's really cloudy and rainy. And yeah, if you're watching or following the Euro Cup, we are hoping that Germany will win against Spain, but yeah, the better team will probably take the crown.
Perfect. Yeah, there are many similarities between soccer and RGM, so they're predictable, but the difficult thing is just as the single shopper is not predictable, also the single game is very hard to predict. That makes it interesting. It's fairly doable to predict the whole season who will win at the end, but it's hard to predict the single game, so that makes it exciting. I'm looking forward to it and I hope we're still in good mood tonight later.
That's all.
Thanks everyone. Bye-bye.
Bye.
Bye.